For almost 2 years, the world has been wondering, when will everything crash? Well, the last 6 months proved the crash has officially begun. Raising rates by 1 or 2% is more than enough to crash the previously soaring stock market. But what exactly did Cathie Wood have to warn on the issue? Let's find out. But what does Cathie think?
Cathie, because you've argued this and you've put this out there in terms of Fed policy, in terms of deflation, when do you think it will come?
I think we're seeing it.
Okay.
I think if you look at a lot of commodity prices, not only are they down 30 to some of them 80% from their peaks, they're down on a year-over-year basis. In fact, oil itself is almost down on a year-over-year basis now. The big pushbacks on this call we get are wages and rents. We're seeing rent inflation reverse quite suddenly and dramatically. So what I think we will look back in history and say, this inflation shock was the function of a supply shock caused by COVID, supply chain problems afterwards, and even more problems after Russia's invasion of Ukraine.
Many companies that exploded their stock prices throughout the pandemic have now lost all their gains and are back to the pre-COVID era, or worse. Whoever sold before the crash must have profited enormously. But a stock market crash is not a huge deal since most of the stocks are owned by the top 10% of Americans. However, when real estate/property prices crash, there really is no escape. Everyone suffers since everyone has a roof over their heads of some kind. House prices increased by over 10% in 2020 and almost 20% in 2021. We hadn't seen such price hikes since 2005 or 2006, when the housing market was headed into a crisis that would take the entire economy down with it in 2008. And since the Fed is raising rates again, Cathie notes that house prices are crippling. So the question that many are asking is, will the 2008 housing crisis repeat itself? Are we headed into a similar crisis, and how bad will the crash be this time? We will answer all of these questions and hear from Cathie Wood on why the crisis is about to get a whole lot worse. But before we do that, make sure you like this video and subscribe to our channel, the fastest growing economics and finance channel on the internet. The current crisis is much unlike the 2008 housing bubble. The 2008 housing bubble was driven by different factors. Slack banking regulations led to overrated mortgage-backed securities that were issued by rating companies. Junk loans, or the loans that had the highest chances of defaulting, were mixed and concealed with good loans and were given top AAA ratings. Investors traded these securities based on the narrative that these are stable, great loans that are safe and insured by giant financial institutions such as AIG. But the moment some of these loans began to crack, the domino effect came into effect, which led to the crash of the market and bankrupted giant behemoths like Lehman Brothers. But in this instance, the current housing bubble isn't driven by junk loans or fake AAA ratings, which is deceiving many to believe that the housing market is fine. What we also have to take into account is that there are no two identical crises. Each bubble or crisis is different. Once there is a crisis and we take measures to fix it, we learn the lessons and try our best not to repeat it, at least in the foreseeable future. There are way more rules that were put in place, making it more difficult to get a mortgage now than pre-2008. These rules involve greater scrutiny over individuals' abilities to pay back their loans. Thus, it would be incorrect to imagine that the current crisis will follow the exact steps of the previous one. What we have to take a look at is why house prices rose so much and what are the chances that they could collapse again. If there are such indicators, then a crisis is definitely an option. After the 2008 crash, many home builders went bankrupt since house prices collapsed and building homes was no longer a profitable business. Only the most stable companies survived the crisis. Since the government tightened banking regulations, the demand for houses dropped significantly, which made it even more difficult to sell homes. But a lot has changed since then. Banks are of course still regulated, but getting a mortgage isn't as difficult as it was right after the crash. The housing market began to grow at an average rate of 1 to 3% at best since the supply of new houses in the United States was at a stable rate. But if you look at the date, more and more developers jumped into the game when they saw that mortgage rates were at a historical low and the demand for houses is at an all-time high. Even though the pandemic created such a huge shortage of real estate, starting from 2021, the supply of new homes began to rise to the point where it's almost doubled the pre-pandemic level. They have begun slashing prices to be able to sell now since the Fed is literally raising rates at every opportunity. Higher interest rates mean higher mortgage rates, which mean lower demand. Lower demand means it's difficult to sell your house. So it's better to cut prices and sell now before the Fed hikes rates further and makes it even more difficult to sell. Builders are slashing home prices and slowing construction as buyers pull back in record numbers. Sellers are slashing home prices the most, which is another reason why real estate is to blame for America's spiking inflation problem. Up until February or March, we had the absolute opposite happening, where buyers would start a bidding war just to be the one who was going to purchase this or that property. Demand back then was so high. We've seen headlines multiple times where people were overpaying 20, 30, or even 50% just to buy a certain property. We were also in an uncertain period where we thought that the world might end. The media was shouting all over the place that we had no idea how long it would take for us to get back to work. People got scared. They were not ready to sell their homes, fearing they would be left out. But today, fast forward a couple of years later, we are now facing challenges such as a real conflict in the middle of Europe that's endangering the current world order and vastly impacting international energy prices. The media is no longer focused on COVID cases, and people are getting back to their pre-COVID lifestyles and are back to selling their homes. Some people waited 2 years just to sell their homes. Why sell now when prices could rise tomorrow? The last time we had a similar crisis was in the late 1970s after the Iranian Revolution, when oil cuts sent shockwaves across the globe, raising oil prices. By 1979, inflation reached a startling 11.3%, and in 1980 it soared to 13.5%, and then the economy fell into a recession. In all honesty, if we look at the date, things are much worse than they were back then for multiple reasons. First of all, Russia is not Iran. Russia is much bigger and deeply integrated into the world economy. It doesn't just export a lot of oil. It's the largest gas supplier and the largest wheat exporter on the planet, and it's invading a country that's also one of the largest wheat exporters in the world. The effect of sanctions in this area have already been catastrophic, and the idea that wheat shortages could start to cause global food shortages and possibly even mass starvation has put terror in the hearts of world leaders across the globe. We also never previously had a global pandemic where we printed trillions of dollars to make sure everyone stayed at home.
If I can just take 1 second, I would like to give an analogy to the late 19-teens. We were in the middle of the massive, most massive innovation the history of the world had seen: telephone, electricity, and automobile, all at the same time. But we had World War I, and we had the Spanish flu. Sound familiar? Now, that was much worse than what we've gone through. We've gone through nothing like that. But there were massive supply chain problems back then. And inflation peaked at 24%, right? In June of 1920. And by June of 1921, it was minus 15%. So I think that our 8 to 10% inflation, which is where it was at the peak, is going to turn around, and we're going to see some very big surprises on the inflation front. And you know who agrees with us? The bond market. Look at what the bond market is doing now. The long bond yield, 380, 75% inverted. That's telling us that the bond market is saying recession and or big surprises on the low side of inflation expectations. And it's probably both.
The Fed raised the rates first to around 10%, then to 19% by January 1981. Think for a moment how high mortgage rates would be if interest rates were 19%. I think mortgage applications would drop so much that home builders will start going bankrupt again as they did in 2008 and 2009. This would also no doubt cause a rent crisis, as landlords would be forced to raise rental payments in order to keep their properties. People could likely start to slash prices more just to be able to sell, since the demand will simply vanish. Only those with cash would be able to buy. By the way, only a third of home buyers pay full cash, and more than 65% of home buyers finance their homes with a mortgage. This indicates just how much of the West's population is vulnerable to this kind of risk. Another reason why the housing market crashed back in 2008 is because when people with bad credit history defaulted on their mortgages, prices began to decline by 10-20%. When people who actually could afford their mortgages realized that their $500K mortgage was now worth only $400K, they also defaulted on their mortgages, since it didn't make sense to keep paying a mortgage that's much more expensive than the actual prices of the house. This only serves to drive house prices further down. We are seeing the exact same trend now. House prices rose by almost 20% last year alone, and this year builders are slashing their prices. The number of active listings are going up, and mortgage applications are going down because mortgage rates are rising. And if inflation is not going to come down, the Fed will keep raising the rates to crash the demand. To make matters worse, we will most likely face a recession, as we've discussed previously, since the world is on the brink of an energy and food catastrophe, which will further lower the demand and, in turn, bring prices further down. If real estate prices decline by 10 or 15%, what will homeowners who took hefty mortgages in 2021 do? Will they keep paying their overpriced mortgages? If the answer is no, can the Fed afford to slash interest rates again? It can't even bring down inflation after multiple rate hikes. I don't think they will risk lowering rates in the coming future. It's a recession that we will have to swallow. I know that the Fed keeps saying that they are not seeing any signs of recession, but the Fed currently appears to be rather incohesive with its communication.
You know, I can write an open letter to the Fed and put it out over Twitter. Now, do I think the Fed's going to listen to me? No, I don't. But that they may listen, the Fed board members may listen to someone who might think that I have something to say, which is simply a question. Wait a minute, how can you be unanimous 75 basis points at a time? How can you be unanimous when there is so much conflicting data out there, including an inverted yield curve now at 75 basis points? That's crazy. I think we're going to look back in history and say, what were they thinking? Unanimous? Commodity prices are falling. You've got excess inventories all over the place. We're seeing massive discounting. I think we're going to see deflation, and then they'll make a move in the opposite direction. But we need a steadier hand than that.
What the Fed says matters the most. Remember, back in 2021, we already had the data that inflation was getting out of hand, but the Fed calmed us down by saying that there were no signs of inflation. Even most of the media was in abject denial of the risk of inflation. But when it happened, the Fed didn't instantly raise the rates, but warned the market instead. The market didn't appear to listen. Then they said that the U.S. is not in a recession, and now Jay Powell says that a recession is a possibility. Can we really trust the Fed, since the job of the Fed is to calm down investors and make sure that the recession does not appear as painful as it really is? Indeed, it's difficult to say for sure what's going to happen. But looking at all this data now, a housing crash that's as bad as the 2008 crisis is a real possibility if things continue the way they are now. But only time will tell. Let us know what you think in the comments section below. Make sure you like this video and subscribe to our channel, the #1 finance channel online.